Welcome to the Debt Investor. Today we are going to learn about syndications versus notes, which one is better and why. So if you don't know what a syndication is or what a note is, don't worry, I'm going to explain it all to you. We're going to figure out what they are, and then we're going to figure out which one's better and why it's better. So they serve different purposes. Let's just get that out of the way. But what actually are they? Well, a note is basically you lending someone else money. Okay, so when you go to the bank to get a loan, if you borrow $30,000 on a $50,000 property, they now hold a note worth $30,000. Now it gets paid off every month, yada, yada, yada. But that is the premise of this. It is literally when you go borrow money or somebody borrows money from you, the person who lent the money or the entity that lent the money gets a note, a promissory note, and then either a mortgage or a deed of trust in our case because it's on real estate. But that is what a note is. It's literally just you lend someone else money. So what's a syndication, right? Because we need to know what that is. A syndication is pretty simple too. It's where somebody goes around, and this person is called a GP or a general partner, and they pool up all these people's money. So they go and get, it's usually more than 5 people, and they put it into a big pool, and they use that as their 20% down to go buy a property, right? And so this is what, like if you know who Grant Cardone is, this is what Grant Cardone does. He goes and takes a bunch of people's money, whether it's $10,000, $100,000, or $1 million, and he might go raise $30 million and put it down on a $200 million apartment complex. That is a syndication. So from a risk perspective and a reward perspective, which one of these is better? Well, I don't know about you. Recently, Brandon Turner, the Bigger Pockets guy, he just lost $15 million of investor capital in a syndication. Now, sure, banks, the main note holder, they take capital losses too, but it's not as common. So with a syndication, right, we're going to talk about the ups and the downs. You do have potential to make unexpected money, not necessarily more money, but unexpected money. And so what happens is they might pay an 8% pref. And so what an 8% pref is, that's preferred return. So if they pay $10 million for the deal and it cash flows or whatever, makes $1 million that 1 year, the first $8 million goes to investors. So if it makes $1 million, the first $800,000 goes straight to investors, okay? And then the remaining $200,000 right here, between here and here, is a waterfall. So it's either a 15/85 or 20/80 or whatever the split may be, right? 50/50, depends on who it is. And then part of it goes to the person who set the fund up, and part of it goes to the investors. And so your upside is hypothetically unlimited. It would have to perform really good because of the splits, but it's technically unlimited. Now, 80/20, you're not paying too many fees, but I mean, 20% of your money going to somebody else just for putting it together. Or it depends on who you are, but that doesn't sound very good to me. And so now let's use a flip case and say, well, this made 1.2 million. Over here, you're 200,000, so 800,000 plus 160. You'd make $960,000 as the LP pool, okay? Now, if we did 1.2 million minus 800,000, oops. So this goes straight back to investors. Now we have 400,000, right? Times 0.8. What is that, 320? Yeah. 320,000 plus 8. So now we make 1.12 million versus 960. See? So we can make more money than we thought we could. Now, that is a little bit different than notes, but before we get to that, we have to talk about the risk. So what is the risk here, okay? We have what is called, here we're just going to do it out together, and this is going to be on risk. What? Cool. So we have what is called in every deal, what is called a capital stack or a cap stack, whatever. People use fancy lingo to describe stuff all the time. Imagine those are the same size. And so your syndicator, they're going to go and they're going to pool the 20%, so they're going to get this money, right? And they are going to borrow the 80%. It might be a little different. It might be they're going to borrow 85, or they're going to borrow 90%, or they're going to borrow 70%. But typically it's 80-20, something close to that. And a note, the same thing, right? So somebody's going to come in and they're going to put 20% down, and we are going to lend them the 80%. Okay? And so now these situations are the same. We're just in a different position. Instead of owning the property, we own the note. And so if you notice here, it's literally the same, other than these labels are different, but it's still, there's a lender in place. And so what happens here, say these are both $5 million properties. If these go down to $4 million, who loses their money, right? Is it the syndicator or is it the lender? Well, it's a good question, and who knows? Well, I do, but yeah, that was just a dumb question. So if it goes from $5 million to $4 million, 80% of $5 million, that's a $4 million loan. The syndicator just got completely wiped out. So investors that thought they were going to make 12%, they went from plus 12% to negative 100%, right? And that's what just happened in Brandon Turner's fund. They wiped out every single bit of investor capital, unfortunately, but that's what happens when you invest in a syndication. And so this is the first capital loss. Up here is this. So the syndicator's money goes bye-bye first, and the bank, in this case, is last to lose, or the lender. So your 80% is safe as long as this is safe. Now, with a syndicator, you are also hoping that the operator is competent, because if they're not competent, you have no upside, right? If they go and just raise money just to take the fees, the 2% acquisition fee and the management fee and all the fees, you're screwed. So you better do your homework on them. Now with a note, once again, this could be the syndicator, this could be whoever, but they can lose their money and your 80 is still protected. So it's a little bit different. Instead of losing your money first, you lose your money last, which in my opinion is a heck of a lot safer, and mathematically it's a heck of a lot safer. And so your 80% is protected. Now, the operator, when you lend money, you still prefer they be competent, but it's not as required, because they can still lose their 20 or 25 or 30% down. Your money's protected, and then worst comes to worst, you end up with the property. And the way we structure stuff, actually, the worst case scenario is that we get our money back. So notes are last to lose, syndicators are first to lose, and so syndicators are more risky by a lot. They're just, you can get a little bit more upside. In my opinion, the juice is not worth the squeeze. And so now let's talk about upside of notes, right? Because we talked about syndications and how we can make an extra couple percent. With a note, what I like is you know what's going to happen before even a dollar of your money's on the line. So think about it like this. If I come to you with a deal and say, hey, it's a $50,000 property. I need a $30,000 loan. So that's going to be 60% LTV, pretty safe. Banks go up to 80. Okay, and I'm going to pay you this $30,000 at 12% over 7 years, and I'm going to pay you $529 a month. Okay, you know you have not put a dollar of your money out, and you know exactly what is going to happen. So either I pay you $529 a month, or you get the property back. It is that simple. You're not guessing, you're not gambling. It is defined beforehand. So, hey, I need $30,000. In exchange for that, I'm going to put up this $50,000 property as collateral. And if I don't pay you your $30,000, you get the $50,000 property. Now, when I pay you back, you're going to get 12%. So you have two outcomes here, either 12% or property. And the property is worth 50 grand, right? In my opinion, that is a much better way to do deals, whereas with a syndication, what do? You hope and you pray, right? You hope that the operator is competent. You hope that the property appreciates. You hope that the market's strong. You don't know. Your money is not. You are not in control of your money. You sent it to someone else and said, here it is, play with it, and now you're stuck at night hoping that it's going well. And there's actually a couple cases I heard of syndicators losing all the money and not even telling their clients. So do with that information what you will. I'm not going to name any names, but Brandon Turner's out there. There's a few others. So this is the difference between notes and syndications. It's pretty simple. In one, you are the borrower. In one, you are the lender. The lender is last to lose, in which that will be notes. I'll just tell you, banks, some of the largest and most profitable institutions in the world, they don't do syndications. they buy notes. There's a reason for that, and there's a reason that you should too. So that being said, I hope you enjoyed. More importantly, I hope you learned something. If you want to learn more, check out our channel. In the description, there's a link to our free course. It's a couple hours of free information on note investing. I'll never charge you a penny for anything. So that being said, once again, hope you enjoyed. See you in the next one.